Welcome back, everyone, and thank you for joining us for another Prime Capital Financial Market Breakdown. I'm your host, Tara McBride, Chief Marketing Officer at Prime Capital Financial. Inflation may be cooling off, but it seems there is no limit to how hot the headlines can get. From surprise consumer price index shifts to presidential trade frameworks and the ever-watchful eye of the Fed, there's no shortage of moving pieces in today's economic puzzle. As always, I'm joined by my colleagues, Portfolio Manager Clayton Allison and Deputy Chief Investment Officer Will McGuff, to digest what really happened in May, why those tariffs haven't hit your wallet just yet, and whether Fed Chair Jerome Powell is finally ready to blink on rates. We like to give you a little something that can help you zoom out on the issues, so don't forget to download our free companion piece, 12 Retirement Risks Everyone Should Prepare For. It's a quick hit list of the risks you should avoid and take into consideration as you construct your financial plan to help you stay one step ahead. You can scan the QR code on the screen or click the link in the show description. All right, let's roll. Clayton, give us a breakdown of what the numbers look like and what changed in May.
Yeah, thanks, Tara. So the numbers in the May print were largely not that surprising. They were pretty much stagnant year over year for both the headline and the core number. You had headline coming in at 2.8, core coming in at 2.4, but really kind of the piece that everybody kind of latched onto is really that month over month figure, where both headline and core only increased by 0.1%. That's a drop off from the prior month's acceleration rate. And kind of where you saw the easing come through from was from that core goods standpoint and also core services, primarily leading the charge because shelter is such a main component of inflation that whenever that does kind of come down a little bit, it makes a very impactful reading for the inflation index because shelter makes up around 60% of CPI. Now, we also saw some moderation on core goods, like I mentioned, but that's stuff like apparel, used and new cars. So that's kind of telling us that more or less the consumer is starting to pull back a little bit and spend less on these discretionary purchases rather than maybe just prices coming down themselves.
Gotcha. So, I mean, my initial reaction was these monthly numbers might be a sight for sore eyes, but maybe there's some more behind this. So, given some of our previous conversations and reading those white hot headlines, I thought tariffs would have more of an impact by now. Will, can you break down why that hasn't happened yet?
Yeah, thanks, Tara. And as you mentioned, the 2.4% CPI reading does look tame despite those headlines. And in my opinion, headlines are just that. Right now, we don't really know how this tariff and trade negotiation is going to play out. A couple of events coming this summer that could change the course there as well. We've got 25% tariffs on Canada and Mexico, 10 to 125% on China, depending upon when you're looking at it and what type of news is out there. But all this is through supply chains. So companies have been stashing up inventory because they have known tariffs are coming, so they can delay price hikes and not pass the full tariff costs on to consumers quite yet. And also, let's not forget, tariffs are on imports, so domestic goods are not tariffed. So there could be some creep with rising prices for American goods too. But all that said, you also hit the nail on the head with Americans are, I think Clayton did, with we're pulling back on spending. So savings rates have gone up, which dampens the demand side of inflation. So long-winded way of saying is that, tariffs could be inflationary, they could be transitory, as Fed Powell likes to say, or they could have no impact at all. And it's just going to have to wait to see how this plays out over the next couple of months.
So, the president recently announced a trade framework with China, and I imagine having some clearer direction on what has been a pretty fluid situation is probably a good thing. Will, what are the details of the framework and how does this impact this inflation picture going forward?
So you're right. There was another framework announced today. I would also just be wary of these things coming to fruition. We've seen these trade negotiations bounce around. Numbers have been thrown out all over the place. The math on tariffs has been different for different types of tariffs. So that said, what China, U.S. agreed to in Geneva was a 55% tariff on Chinese imports into the U.S. So that's a 10% reciprocal, a 20% fentanyl tariff. And let's not forget that tariffs of 25% still exist. Previous administration had them, and they're still there today. China's going to be at a 10% tariff on U.S. goods. So, essentially it's a deal where both parties have agreed. China's also going to supply rare earth and minerals to the U.S., while the U.S. is going to allow Chinese students in their universities. So on paper, seems like a good deal. Markets are kind of ho-hum about it today, not really moved one way or the other. But I also like to remind folks that goods that we import from China tend to be very high margin goods that are sold here in the States. So 10, 20, 30, 40% tariff on something that's imported for a few dollars and then marked up, 10, 20, $30 is a lot easier to digest for these companies than, imports such as automobiles or higher price items with lower margins. So again, all news out there. We'll have to wait and see how it all plays out.
It's great to hear, we've talked about these concepts before, so it's great to kind of hear these ideas reinforced as we continue to move through this entire situation. So we know the Fed's goal is to maintain inflation steadily around 2%. Clayton, does the president's announcement change the Fed's stance on rates at all?
Yeah, I don't really think that it does much right now. Like Will mentioned, the market had kind of a, like he said, ho-hum reaction to the announcement of the trade framework, and I think that's exactly kind of the stance that Jerome Powell and the committee are going to have as well. Because like he mentioned, all this does is kind of reset the agreement back to what they already agreed upon in Geneva. So you still have an additional 10% baseline tariff still on all imported goods coming in from China. Now, like Will mentioned, these are high margin goods, but any tariff is not necessarily a great thing to the end consumer of the United States. So in the end, I don't really feel like this is going to drastically change the Fed's policy stance right now, because the last thing they want to do is take their foot off the brake and allow inflation to reaccelerate. And while you still have a pretty resilient, strong labor market going on right now, consumer spending isn't completely dropping off yet, and the labor market has not been rapidly hit by this. In addition to the tariffs not really being passed through yet to the end consumer, I don't think that the Fed is going to want to start cutting rates by a large magnitude yet. I really expect next week's meeting for them to leave everything unchanged, but you'll start to see some better probabilities come later on in the year, probably around that September timeframe meeting, to possibly start cutting. We have seen kind of market pricing in 2 cuts this year, starting around September, of around 25 basis points each. But I don't think that Chairman Powell and the committee are going to want to all of a sudden cut an entire percent like the president is asking for.
Wow, never a dull moment, right? So tariffs, trade talks, taper tantrums. Welcome to yet another economic plot twist none of us saw coming, except for my colleagues here. They're always ready. Big thanks to Clayton and Will for making sense of the data behind the drama, and thank you for tuning in. Want to dig deeper? Download our free resource. Scan the QR code, make sure that you're prepared for retirement. As always, we talk about financial plans. If you are not working with somebody or do not have a financial plan, make sure you reach out. We'd love to talk to you. Scan the QR code, click the link in our notes for the free resource to get things rolling. Until next time, remember to stay informed, stay invested, and as always, we'll be here to help you navigate the twists and turns of the market.